All right. Back live again after what, 2 weeks today? Well, today we are going to be talking about another episode, and what we are going to be diving into a little bit is tax free retirement accounts, which includes IRA. And we have none other than, my buddy and partner, Tom Bibby Varghese. I'm going to be asking him some questions because this is something which is even kind of like, I would say not new, but I'm still a little bit confused. So, everyone, my name is Noah Liu. I'm a general dentist based in Peoria, Illinois, and we like real estate. So, without further ado, let's go, man. Let's do it.
Yeah, let's go. Hey, good afternoon, everybody. So excited for another episode of our free Facebook Live tips. Today, we are going to talk about how you can grow your money tax free in retirement accounts like IRAs, Roth IRA, etc. My name is Tom Bibby Varghese. I'm an entrepreneur and a good friend and partner of Dr. Noah Liu. We both started this group a couple of years ago just to educate people on how you can grow your money using real estate. Now, see, right now is the perfect time to talk about real estate because I also invest in stocks and everything, and I do pretty actively. But in the last couple of weeks, man, stock market took a beating. A lot of these stocks are in the red. A lot of people lost money. I think trillions of dollars came down, and that's when I started thinking, man, I mean, I always knew about it, but real estate doesn't happen like that. You get your cash flow, it's pretty stable. I mean, there are some market fluctuations, but it doesn't go down like 10% in a day or 15% like Nvidia. A lot of people are investing in Nvidia, and I think it's down like 15 to 20% in the last just a
Mhm.
couple 2 or 3 weeks alone. So today we are going to talk about um, how you can grow your money tax free, use that same money to invest in real estate and other assets. So, yeah, let's get this
All
going.
right. Let's kick it off. Let's do it. So, I'll give you an example. Dentists, doctors, most of our colleagues, we have active income coming in. A lot of times I've heard it from my CPA as well. Take some of the money, put it in an IRA account or put it in a Roth IRA account. I want to pick your brains, Tom, and let's talk about a little bit about what are the different IRA accounts, because sometimes it even kind of bothers my head. And I know there are a lot of people in this group that knows about all these IRA accounts, but for some of the newbies that's starting off and have just like me have really no clue about the in depths about IRA.
Yep, yeah, let's talk about IRA. So there is multiple types of IRAs. By the way, we are not accountants or investment advice professionals or financial advisors. We
Mm-hmm.
just give you information for what we have done and what we have learned, and it's not advice in any way. We just information. Okay,
For
so we,
entertainment purposes only.
yeah, for entertainment only, and we have to put that disclaimer out there. So let's talk about IRAs. What is an
Yeah.
IRA? It's an individual retirement account. That's what it is, basically. In America, everybody has to fend off during retirement. Nobody's going to take care of you if you don't take care of yourself, right? It's not a socialist country.
Right.
So government created these programs called individual retirement accounts. First of all, you got to know there is there are multiple types of IRAs out there. Today, let's focus on just a couple of them. The most common one is a traditional IRA or traditional retirement account that anybody can open and put money into. Then there is another one called Roth IRA, and
Mm.
where also anybody can open and put money into. Now, the question is, which one should I put money into, right? Should I put into a Roth or should I put into a traditional? That's the thing. That's the question most people ask. So let's talk about traditional IRA first. And traditional $1,000 per individual per year, and it goes up $500 every year, like the limit. So if you and your wife are putting money into, you're talking like $14,000, $15,000 a year, right? And now in traditional IRA, whatever you put into that IRA is tax deductible. So for example, let's say you make $100,000 a year. and you put $7,000 into the IRA. Now, all of a sudden, you only have to pay taxes on $93,000 a year. That 7,000
Oh,
is
okay.
tax deferred.
Mm.
Yeah,
Okay.
meaning when you take it out. So you cannot take out IRAs until you hit retirement age. So which is I think it's 65. I'm not sure 62 or 65. So that gross that income you put in there, and then you can buy stocks, you can buy crypto. Sorry, crypto not allowed. You can buy stocks, and then you can also use the money to buy real estate. And all that money in that account is growing, and you only pay tax when you take it out. Okay, I mean you got it a tax free you got a break on the taxes when you put the money in. Now the money is growing, so whatever it grows, when you take out, you got to pay taxes. So that's why it's called as tax deferred account. Does that make
Oh,
sense?
okay. So hey, so let me ask you this: even if you do it at retirement, you still pay, correct?
Yes, when you pull it out at retirement, you still are going to pay taxes. Now that's where you got to make the decision: should I put money into a traditional IRA or should I look at some other means? Okay,
Okay. So
that's where the Roth IRA comes into play. So now Roth IRA is was created by the government where anybody can put money into just like the other one, but you're not going to get any tax benefit immediately. Like so same thing, $100,000 a year, you put in $7,000 into the Roth IRA account. You're
okay.
not going to get any tax benefit right now. But here's the key, guys. All that money that you put in your Roth IRA, it grows tax free. So let's say you put $7,000 every year, and 10 years later, you have contributed 70,000 into that account, and it's growing every year at the rate of 15% or something, right? So let's say that money is 200,000 now. So you're sitting on $130,000 worth of profit. That money, when you take out, you don't pay a dime of taxes on that. So is that clear?
So this is what I understood. Whatever you do year after year, like starting today in a Roth, I'm paying money, I'm putting money in after taxes, correct?
Yes,
And whatever money that's growing in that Roth IRA, any growth, any gains, I'm not paying taxes on when I
absolutely right.
pull up.
Yep. Mhm.
Wow. Okay. And what is the limit on Roth IRA per year?
So yeah, that's an interesting question. So the contribution limit is, I think it's 7,000 right now, or 7,500 if you're over 50, or maybe it's 8,000,
Oh
but
wow.
7,500 per person. So if it's a couple, you times it by two, right? So now here's another thing what you got to watch out for. Roth IRA may not be available for everybody because there is an income limit. If you make
Hmm.
over a certain amount of money in a year, you are not eligible to contribute to a Roth IRA. But there is a solution to that. So let me look at that number. So it is, I think, $236,000 if you're filing jointly. If you're filing as an individual, it's $150,000. So let's say you cannot contribute to that because of the income limit, right? So
Okay.
if you're single and if you make over $150,000 in W-2 income, you are not able to put into a Roth IRA because of that limit. But
Wow.
here's what you can do, though. There is something called as backdoor Roth. It's perfectly legal, although the name is backdoor Roth. What you want to do is open up a traditional IRA account. Okay, you open up a traditional IRA account, you put $7,000, you got that tax break on putting that money in, and
Mm-hmm.
then you convert that traditional IRA account, you roll it over into a
Mm.
Roth IRA account. That is
And that
perfectly fine.
and that is not income dependent. Doesn't
That's
matter.
not income dependent because you can roll over from one retirement account to the Roth without having any problems. But now that $7,000 will become taxable though when you put in. But that's fine because you would have paid taxes on that
Exactly.
anyway. So, but
Okay.
what you want to do is what you're thinking is long term, right? So right now everybody knows the taxes are not that high actually. because there are countries in the world who are taxing people at 50%, 60%, and all that. Compared to that, United States taxes are pretty reasonable right now. And during the 80s and stuff, the US had pretty high taxation rates. And if you think about it, and with the way the deficit and everything is happening, until something drastic happens, when we get old, I think we'll end up paying more taxes. So at that time, if you want to save on taxes, the best way to do it is using a Roth IRA account.
Hey, unless Doge does a good job.
Unless Doge wipes off the IRS, or wipes out the IRS, or wipes out the federal deficit or something like that, then we don't have to worry about any of
Right,
this.
right. So this other term that gets thrown around a lot, what is SEP?
Okay, so now there is another type of IRA account called SEP IRA, which is
Uh-huh.
self-employment professional IRA account. That is
Self-employment professional. Okay.
IRA account. So now this one is a IRA account if you own a business. If you own a business, you can put 25% of your salary into this SEP IRA account.
Mm,
And the business will write it off as an expense. So if your business is, say, XYZ Dental, and you made, for ease of calculation, let's say you made $100,000 in profits, and you're saying the owner is Dr. Noah Liu, and you're writing him 25% of whatever. Let's say you got a salary of 100,000, you gave him $2,500. So now that income is that SEP IRA contribution is from the business to the employee, and that's an expense on the business. So you don't pay, the business does not pay taxes on that. Okay. And now that is just like a traditional IRA. When you withdraw it, you'll have to pay taxes on that.
oh,
But
okay.
here's the thing. You can convert that. You can roll that SEP IRA into a Roth IRA immediately.
Oh, wow.
Yeah. So eventually you will never end up paying taxes on any gains that you have on that growth.
So is this the same way where a lot of accountants talk about if you're going to be getting a SEP IRA, you have to get it for your employees as well?
Absolutely. I was going to address that.
Yeah,
Yes.
yeah. Let's talk about that. That's what I
So
heard too, and I wasn't sure.
yes, for SEP IRA, the only issue is if you've got employees, you've got to offer the same benefit to all the employees. So if you've got 10 employees, unfortunately, you got to do it. But here's the way to do it. So let's say you got to have multiple LLCs for this to work. So you have another LLC, and let's say you have a side business or something like that, or maybe another business that holds a trademark, and you pay that business and you draw income from that. The SEP IRA works best when it's only the husband and wife owning that business. And
Mm.
then all the income that you're taking in your W 2, sorry, not all the income, 25% of the income that you're taking in your W 2, you can put it into SEP IRA. But the goal is to convert that immediately into a Roth so that you can grow that money tax free. And again, this works for people who are pretty young. I mean, if you're 65, it may not be the best strategy, but if you're like in your 30s, 40s, 50s, this is a really good strategy to grow wealth.
But you said up to 25%, right?
Up to 25% of the W 2 income you can put in SEP IRA.
Oh, okay. And let's say if it's an employee benefit, how does that work? Is that something where they are making whatever amount, I'm taking 25% off and I'm putting it out of the business's account? Is that how it works?
Say that one more time.
How does it work for employees? So let's say if an employee gets, let's say, for example, $1,000 in 2 weeks, right?
Mm.
So are we taking 25% off from their paycheck, or are we putting it from our pockets if it's for an employee?
Okay, so let's say you have another employee that's not the owner of the business, and they're pulling
That's
in a
not the
hundred.
owner.
Yeah, pulling in $100,000 a year, right? Let's say, for example, they're pulling in $100,000 a year. Now, that 100,000, you can't touch that. This 25% contribution is
Uh-huh.
outside of that. So the
Oh,
business is saying, I'm giving you another 25%, $25,000 up to, it's up to. So you can be like, I'm giving you 10,000, and it's going into your retirement account.
Got it. Got it. So that's like a benefit package,
Yeah,
right?
that's a benefit, right?
Okay. Okay. I got it. Makes
But
sense.
the thing is, if you offer them a percentage, if you offer yourself a percent, that same percentage should be given
Has to
to
go,
everybody.
which is why you said it's better if you have a separate LLC and then
Separate
you
LLC. Yeah.
makes sense. Makes sense. I love it. And what other IRAs? Any other IRAs? I know we heard of many other different kinds,
Well,
but
there is a Roth 401k and all that, but that's similar. That's just like a 401k account, but where you put money in and you pull out tax. All the gains are pulled out tax. I mean, without any paying any taxes.
cool, cool. And let's lastly touch base on self-directed IRA.
Yes, that's where we were going to finally we are getting to now. Now all this money in your IRA, regardless of whether it's traditional IRA or Roth IRA,
Hmm.
right? That is your retirement account. Now you're limited to buying stocks and mutual funds if it's an IRA. However, there is something called as a self-directed IRA where you want more stable income. You want to invest in alternative assets like real estate or even crypto and other things. You can buy businesses. There is so many things you can do with that, but that's not possible in a traditional or a Roth IRA. But what you can
Mm,
do is you convert that into what is called as a self-directed IRA. And in that, you can buy pretty much any type of asset. You can invest in oil, you can invest in real estate, which is what most people do. I think 95% of the people end up investing in real estate, and that money is growing. So if it's in a Roth IRA, let's say you purchase a piece of property, okay, and 10 years down the line, and the property became $2 million and it's over $1 million in profit, you don't pay a dime in taxes on that $1 million. As long as now, here's the thing. Oh, one thing I didn't say is that the Roth IRA, you can only start withdrawing after 15 and a half years of age. You cannot withdraw it right away.
mm. So I'm kind of thinking, just thinking out loud here. So there are about 32 million businesses in the United States,
Mm-hmm.
right? Out of which 25 million of them or 26 million of them currently are one or two employees.
Mm-hmm.
So is this kind of coincides with maybe this could be a strategy that many can employ, that just keep one or two to go either, getting a SEP IRA or maybe like getting a, like the self-directed IRA or a solo 401k, because even that is part of the long-term strategy to invest in real estate, right?
Yes,
Because
yes, right. That I mean, if they're running a business, it's a family business, husband and
Mhm.
wife, and some of these businesses make good, like really good profits. So this was really started for them because if they're just a two-person operation, they don't have any other retirement vehicles. So this is a really good way to start saving for their retirement.
right, right. All right. So I mean, what else? What else, Tom? I mean, is there any other retirement vehicles that
I
someone can
mean,
take advantage?
I would say the other one is, I mean, there is, in terms of retirement vehicles, this is pretty much the best that I've found. I mean,
Mhm.
there is other forms of, like I said, 401ks, and there's, other strategies that you can do, which is like, related to your business and all that. Maybe we should talk about that another time. But in terms
Sure.
of IRAs, I think these are the pretty core ones. Think about it: Roth IRA, traditional IRA, rollover IRA, which is actually rolling over money from one IRA into another, and then self directed IRA. Those are the main ones.
Got it. Got it. So
Oh,
the
and
best
then
way to do
there's
it,
SEP IRA. Sorry, SEP
right?
IRA. I hope I didn't miss anything.
No, I think the way I'm thinking about it is like a tagline, right? So you go from traditional to Roth. So for people making over 150K, go from traditional to Roth, or from there you can go to SEP, all right? SEP and SEP to Roth. And
Correct.
then from
Yeah.
Roth, you can go straight to self-directed and pretty much invest in whatever you want, right?
Correct.
Kind of in a nutshell.
Absolutely. Yep. You got it absolutely right. You summed it up pretty good.
Cool, cool, cool. I think that was really, really good. Yeah, Tom, what do you think? Land the plane now? I think that was
Yeah,
really
I think that
awesome,
was
man.
pretty good information. If you guys have any questions about this, again, we're not financial advisors or accountants.
Mm-hmm.
Just put a comment in there. We would be happy to answer those questions if we are aware of that the answers. If not, we'll reach out to somebody and get you the answers.
All righty. Well, everyone, we're gonna call it a night, and let's make sure we tune in again for next week.
All right, everybody, have a good weekend.
Take care.
Bye.